It's great to have some friends in the audience. I'm glad you could make it. As a very brief introduction, I'm Steve Moss, and I'm the founder and president of Executive Springboard. And we match executives with mentors who help them with their professional growth. And one of those mentors is my co-host today, Mark Panico. And Mark had a career that he held divisional general manager and president roles in large corporations before turning his involvement into private equity as a CEO, an executive chairman, an operating partner, a board member, and an independent sponsor. And if I've left any of that out, Mark, you can add to it. And I'll give Mark a chance to talk a little bit about his background and getting into private equity and some of his observations along the way. But before we get going, just a couple of ground rules. I'd love to have everybody join this conversation when they feel they've got something to add. That would help for sure. But what I'd like to do in this is to avoid chaos. Just either raise your hand or put your comment in chat, and I'll try to keep on top of that. And I think that will help. Also, if you would like a video file of our discussion, if you would put your name and email address in the chat, that way I'll be able to take a look at it as we go along, and we'll be able to forward something to you on that. Okay? Sound fair? Okay. Well, Mark, what I'd love to do is just blast in here and have you talk a little bit about your path from publicly traded to private equity, and what were maybe some of the surprises early on, first year. What were you least prepared for?
Yeah, my career was mostly, as you pointed out, Steve. It was up until I became a CEO of a portfolio company. My career was mostly with larger companies. Um, I left. I was a GE guy. I was a Honeywell guy. Um, I left Honeywell, did a short stint with a company over in Europe, and my boss from Honeywell hired me back to work for Legrand, which if any of you know who Legrand is, they were a private family-held company out of Limoges in France, launching in North America, and very quickly was bought by a company called Group Schneider. When Mario Monti, back in the days when he killed the GE Honeywell deal, he killed this deal as well, and so I joined Legrand, and that was my first stint with private equity. It was the group had turned it over to Vindel and KKR. Um, but I was pretty removed. I was a divisional president, so I wasn't dealing directly with PE, but I felt the effects of it almost immediately. And it's a much different pace. You hear about, companies, especially corporate companies living quarter to quarter. In the private equity world, for those of you that are involved in it, it's week to week. You're looking at 13-week cash flows every week. You're looking at, you know, um, all the things that drive that business. It's a much shorter horizon. Average hold periods are 4 to 5 years. Generally, they don't stretch beyond 7. If again, I should qualify that by saying, depending on what type of private equity environment it is, because there are different types. But if you're involved in a private equity deal that is a fund, as part of a fund, much beyond 7 years. If you're going beyond 7 years, it's because the company's not performing. And so you're generally 5 to 7 years at the outside. And so you're making decisions that are much more short-term focused. Not that they're not trying to grow the business, but at the end of the day, the two things that they care about are EBITDA and cash flow, and maximizing those so that they can get to an exit. So
Yeah.
very, very different.
Yeah, I guess there's, you can say there's an elegance to the metrics that are being used in private equity. You know, there's probably a lot of other things, both on the private side, a privately owned business or a publicly traded business, where a bunch of other things get conflated in that
Yeah.
you don't necessarily have in private equity.
Yeah, I think it's important to know your customer from that standpoint. You know, what type of private equity is it? Family funds typically don't have a time horizon. They're not trying to appease investors, so they will operate a little bit differently. But typically, if your portfolio company is part of a private equity fund, even if it's an independent sponsor like myself, I'm still backed by two private equity groups, and when we sit down for a board meeting, we're talking cash flow and EBITDA. You know,
Right,
so
right. Um, I want to come back to a couple of things about when you first got into private equity, having had that experience with Legrand, and what were some of the things that you were least prepared for, or where were some of the biggest points of struggle for you when you started in that environment?
yeah, I would probably spin it a little forward to when I got to stay online as the CEO, because, like I said, I was somewhat removed from some of the things that had to be done with private equity in my role at Legrand. But
Right,
I think focus the heavy focus on cash flow was something that I wasn't used to. I mean, I was part even Legrand, even though they were private equity held until we went public a couple of years later. Cash was never really an issue. I mean, obviously, as the CEO, you're looking at cash flow and cash on hand, and you're balancing that with acquisitions and things of that nature. But it's a much more focused real-time game when you're talking about a 25 to 50 million dollar portfolio company, and you've got to make sure that your cash flow positive out 13 weeks, because you've got payroll to meet and bills to pay, and if you're especially if you're even trying to do any types of acquisitions. A lot of private equity firms want to get the company off on a great foot, because they would rather do a deal based on debt and than equity, at any kind of
right.
add-on deal. And so, they're looking for as much cash flow as they can so they can get leverage.
Yeah, yeah. Um, you mentioned that there are certain different kinds, and let's focus on the funds. Let's not let's the family offices kind of operate in their own thing with really long time horizons. Maybe that can be a topic for another day, but
Right,
um,
exactly.
I'm kind of interested in what you observe between the PE firm and the operator in terms of maybe how their time horizons may be different. Whether there's sometimes tension between hitting a quarter and doing the investment you need to build for scale.
Yeah, I mean, I think that really depends, number one, on the size of the company, the reason the operator, CEO, or the owner, if he's staying on, he sold to begin with. I've been involved in some deals where, I mean, I'm involved now. My portfolio company, you know, the owner, who's now our president. I mean, he has a very realistic view. Number one, he knew why he wanted to sell this company, and that was he wanted a second bite of the apple, and he knew that he couldn't get the level of investment into the business that he needed to do on his own
On his
to
own.
get it there. So he's a great example of a perfect relationship, a guy that knows the business, wants to stay with the business, and understands what the outcome is, and is bought into that outcome. And it's a lot easier to you know do add the kind of structure you need to add, maybe do some small cultural changes on approach when you're in that environment. And on the other hand, I've been in environments where guys are unrealistic about why they're selling the company. They just think it's because somebody's going to write them a nice big check, that they can throw back into the business any way they please. Um, and those are the worst kind, because you're constantly fighting, the management. as far as what needs to be done, how they need to manage investment, the kind of um, due diligence that needs to be done, not upfront. I'm talking about due diligence in the daily operating of the business, about how you make decisions about where you're investing money, what you expect the outcome to be. And there are a lot of business owners that want to stay with the company that just aren't prepared for that. And it can become contentious.
Yeah. What in your role as a CEO in a private equity portfolio company, kind of curious, what were some of the signals that you got that indicate maybe a difference between how the organization could be optimized, whether it's for the private equity model versus the market, and how much room the fund was giving you on some of that?
Yeah, it's funny. My first experience with private equity as a CEO was I don't want to say it's unique. It probably wasn't unique, but for me, very different because, initially, the private equity firm took a minority stake. It wasn't a majority stake.
Okay.
So the owner still had majority control, and that became a problem because they couldn't get done what they needed to get done, and he was missing. Fortunately for them, he missed enough triggers that they could take control of the company, and then they brought me in. So they were already 2 years into this thing and starting to worry that this thing was going to go a lot longer than they planned. And so, coming in, my first and foremost job was to make sure it was cash flow positive and get the structure in place so that the business could grow. I mean, it was a growth industry. It was custom cabling for data center, a lot of power cables and things of that nature. So the growth opportunities were there. They just weren't being seized on the way they should have been, and the operations part of the business was not set up to handle that kind of growth. And so we had to make a lot of changes, and we had to make them very quickly. I brought in some people that had worked for me prior, that knew how I like to get things done and saw things similarly, and we were able to move the needle. And the nice thing in that environment was that the people there saw it. They knew, and they knew they needed help. And so I didn't have some of the cultural challenges that you might see in certain organizations. Quite frankly, once we got the owner out of the way. So
Right. Yeah,
yeah,
that could be a big piece of it. And
yeah,
was once that happened and you had alignment within the organization, did you find you had the same kind of alignment with the fund, or were there?
yeah. No, very, very much so. I mean, they were. I mean, like it was I think it was a bad situation for them. I think for me, one of the big takeaways is don't you have to, even if you're taking a minority stake, you've got to do the same level of due diligence that you do if you're the majority shareholder. And I don't think this private equity firm, which is I'm not going to name them, but they're a large firm. And in my back then I didn't know what I didn't know. Now 6 years later, I can sit back and say, wow, I'm shocked that they didn't do a better job up front, and they got themselves in a situation where there were things they should have done a lot more due diligence, and they should have never taken a minority stake. Those were
Mm.
two big mistakes on their part,
I,
in
I've
my opinion.
I've got a question in
Yeah.
from Simon. Simon, do you want to uh, bring this up to Mark on EBITDA and cash flow?
Yeah, hey Mark, nice to meet you.
Hi,
Appreciate you taking
Simon.
the time here. Yeah, so you're absolutely right, of course, about the EBITDA and cash flow focus. What I'm seeing in mid-market and up, even lower mid-market and up, is that by the time you've sort of gone through one or two cycles of PE ownership, if you call it the easy stuff, and I'm being a little dramatic there, with
Yep.
financial engineering and cash flow, that's kind of been done. You ought to be operating there because that's part of the purchase price.
Right.
And now the hard stuff, and the reason why people are sticking out for secondaries and rolling over to new funds and everything else, is they're just not getting the growth in that 3 to 5 year hold period, and they're having to say, we had an investment thesis assuming this amount of growth, which of course drops down to the bottom line, and we're not making it because of market conditions or whatever else, and they're rolling over or doing secondaries or something else to continue that ownership so they can focus on top line growth. I wonder if you had a comment on that.
Yeah, no, I've most of my experience has been with, first time PE ownership,
Okay.
but you're absolutely right. I mean, look, I think that's incumbent upon the buyer to understand, up front. I mean, look, any deal I've ever been involved in, we put together a valuation thesis beforehand. How much growth do we expect? Where's it going to come from? We bounce that off the market because you're right. You can get in a situation where you're buying a company based on a certain growth expectation that may or may not be realistic. And you're right. A lot of the low hanging fruit is done, especially when you talk about cost savings and things of that nature. So now you're left in those situations. I think you're left with, what do? You have to go out and do a bunch of add-on acquisitions and hope they're not dilutive, to get the kind of top line growth if you haven't factored, the all those dynamics into it. But it's definitely, again, I've been fortunate. Most of my work is in data communications, so it's broadband and data center type stuff. And so, at least for now, growth isn't a problem. But there are plenty of industries where that isn't the case. And look, you have to understand what you're buying and match your expectations to that. And problems come when those expectations don't line up.
Yeah, exactly. All right, thanks.
Yeah.
So Mark, let me ask, you know, your experience with in the operating side and actually in the investment side too, has been in high growth businesses.
Yes.
And I'm curious what you've learned about scaling portfolio companies that maybe you wished you understood when you started in PE. What worked at an earlier level but fell apart when you get to 3 times revenue?
Yeah, I think, I was fortunate in that, as president of Legrand, the Legrand data business, when I started, it was 60 million. And when I left, it was 600. And so I had the ability to make a lot of mistakes on that ride from 60 to 600. And, the biggest lesson that I took out of that I try to impart on any PE portfolio company I'm involved in is you can't let the growth get ahead of your ability to support it because that is a recipe for disaster. So that means continually re-looking at the organization. Do you have the right people in the right positions? Do you have the right people to begin with? Do you have processes? And again, in the private equity world, you don't want to over process, but you do need processes, everything from demand planning to, product management, toll gate processes, things like that people tend to skip over because I don't want to waste all that time in the process. But what they don't always understand is that little bit of time up front and getting a process in place saves you a ton of time down the road and makes for better customer responsiveness. And I've seen several companies get caught up in the fact that they got so much growth so fast and now they can't deliver because they're not on top of the raw materials, or they're not on top of their production planning, or they're not staying ahead on new product development. And customers will move on, and especially in a fast growth environment like data and telecom, and there's plenty others. But the single biggest lesson is pay as much attention to the internal workings of the business as you do the growth. Even in a PE world where you're talking a 5 year horizon. I mean, the portfolio company I've got right now grew 40% in the last year. You can't get that kind of growth year after year and not, upgrade how you do things, because it will fall off a cliff faster than you can blink.
So this leads to a few things I'd like to dig into a little bit.
Yep.
The first is what the CEO is doing. And what maybe have you seen that changes in how they spend their time as this business is scaling up?
Yeah, yeah, very, very critical. I'm dealing with that now in a good way, but still dealing with it. And it's probably a little, Simon's example of middle and above, set that aside for a minute. In an environment where you're in lower middle market, where the company's anywhere from, let's call it 25 million to 100 million, especially if it's owner founded and owner run. That owner is chief cook and bottle washer, and in most cases hasn't figured out how he has to change, he or she has to change what they do every day. You can't, you got to trust your people more. You can't be involved in every single meeting. You can't make every single decision. And that's not what these guys, it's not how these guys built their business, right?
Right.
They built it when they were employee number one and they had 5 employees and they were involved in every aspect of the business. And that kind of continued as the business grew. You start to get to 25, 30, 40, 50 million dollars, and if you're doing that, you're slowing the business down and the business starts to plateau. And so, I spend a lot of time, with the CEO on that kind of stuff, saying, look, let so and so, let's tell them, let's give them some instruction, let them go run that piece. You back out and you do check-in meetings, but you're not sitting in every meeting and you're not making every single decision, because what ends up happening too is if you're making all the decisions and now you sit in a meeting and you want your employees to step up, if you're in that room, everybody's going to wait to hear what you have to say, and you don't want that, right? And so there's a lot of training that has to go on, and most guys, when you sit down with most people, when you sit down with them, will understand that. Some don't, but most will. But you gotta, it is a cultural shock for you as as an entrepreneur, so
Yeah, I can imagine, in a lot of situations, that founder's muscle starts
yeah,
working against
yeah,
the company and what they're trying to do. But let me build on this a little bit. I mean, because you can there's loyalties that you might have as a CEO, and you have to perhaps identify when loyalty to the early leadership has to yield to scaled talent,
yep,
right? And I think we've all seen this situation play out where you've got somebody who's doing an admirable job in a function, but the decision gets made: is this the person who's going to take us to 3x? And
yep.
kind of curious about your own experience there, either as a CEO or independent sponsor or a mentor on how that plays
Yeah.
out.
I mean, it's tough. I mean, we've seen that play out at my mentor, with my mentee, right? On a couple of people in his organization. I'm dealing with it now. You know, these guys, the people that start these businesses build loyalties over time, and it's admirable. And look, it's not that the person, in many cases, it's not that the person is not capable of doing a decent job. The question is more, are they capable of doing what the job requires at twice the revenue? And if the answer is no, that means it falls on somebody else. Most normally the CEO, right? And so it does take some time. I think you try to you try to start to surround the CEO with some good people. Like I said, we're dealing with that now. He's had a person who's a controller, wonderful person, does a pretty good job, never going to be a CFO, and quite frankly is in a little bit over their head. We're bringing in a CFO. We just hired a CFO with his buy-in, but it takes time. There are some other people in that organization that I think in the next 6 to 12 months he's going to come to the realization that we're going to have to either do something different with, or exit out of the organization. And it's not about cost savings. It's about growth. And the other thing you got to be careful of is some of these companies that grew the way some of these small companies grow. It's a very tight knit organization, and so you want to take your time doing it, because too much disruption, and then you're going to get a lot of voluntary turnover that you don't want either.
Right.
So I don't know that there's a secret recipe for it. It's dicey. I think you want to move deliberately but slowly, and you want to make sure that you can demonstrate, in particular to the CEO, why something needs to change.
And trying to keep ahead of the process too. And
Exactly.
so as you're describing this, Mark, it seems like you've been in a kind of active role in trying to make this happen. I'm wondering how often your experience with in private equity, are they leaning in on some of the decisions for succession in organizations, or do you think that gets left to the operating management?
I think it depends on how much faith they have in the leadership of the business. Most private equity companies have a pretty good idea coming in what changes need to happen and whether the CEO is ultimately going to make it. And I'm not telling you there aren't surprises. There's plenty of surprises. I typically the way I present my role to a CEO, whether it's as a board member or or just an operator or an independent sponsor, is look, I'm here to help. It's kind of like our mentor role a little bit, Steve. I'm here to help you do the things that you want to do that you don't have time to do, and give you the benefit of the mistakes I've made along the way, so that you don't make the same ones, right? And in a lot of ways, that's it. Now, as an independent sponsor, I'm a little more hands-on, only because, and in this case, only because number one, the CEO wants me to,
Yeah,
and number two, because there's so much growth, and we're trying to do, they want to do 3 to 5 acquisitions in the first 2 years. There's no way to do that without me and my partner getting more involved. So,
got it.
but we knew that coming in, so it's not like it was a surprise.
Well, I want to get to that acquisition piece shortly, and I also want to invite other people to jump in. But I got one more thing I want to ask you about. I saw Lisa Trombo. Glad you could join us. And just from your own background, one of the things I wanted to ask Mark about is a bit about the process of hiring CEOs or other senior leaders in portfolio companies, because it seems to me that it often is a little bit unique in private equity. That lots of times the organization looks for high ceiling people, maybe with less experience. Maybe they have experience in scaling. Maybe they have experience in turnaround if it's that kind of business. But lots of times it might be, well, they've been in a business that's 5 times larger than this one is now, and they present themselves well, and they seem to have the right skill set, but they don't necessarily. It's the first time being a CEO. For you, it was the first time being a CEO when you were in a private equity organization, and I'm wondering, for a lot of in those instances, you've got people who are now in the role for the first time in an organization they really don't know, working with a new set of rules that happen with private equity, and that's a lot of the kind of work that we do in Executive Springboard is helping in the senior onboarding spot. You had kind of an unusual thing in that you were working with somebody who had been identified for succession planning as the next CEO, got them ready to become the CEO. Then they're in that role and they're like, holy crap, this stuff is flying at me in real
Yeah,
time. I need more help,
yeah.
on this. So just kind of, I'm kind of curious as what you see, and then also would love to get Lisa's thoughts on maybe some of the differences about how a recruiter, a search firm handles, a senior hire in or search in private equity.
Yeah, well, I think, first of all, my thoughts would be this. I think first of all, you're right, especially on the lower middle market, they tend to try to get by as inexpensively on compensation as they can, and fill as much of the gap with equity. Um, and so that does sort of dictate a certain level of employee that you're going to get. I'm not saying that they're not good qualified people, but probably less experience. And sometimes it works great because the person's ready for that next step and they would have gotten it wherever they were. And sometimes it's an absolute failure, and that's why you see some of these private equity firms that are 3 years in and they're on their third CEO.
Yeah.
And that's, quite frankly, that's how I became executive chair at Lynn Electronics for NewSpring. They were on their third CEO. As a young guy, no experience, nice guy, but they weren't sure he could handle it. And they asked me to come in and kind of oversee everything. So, but sometimes it works out great. Like I said, you get a very experienced a guy with a lot of experience that's ready for that next step. And whether it's private equity or not, he knows what to do. He knows where to look and how to run a business. And it's got, really what it comes down to. And it sounds cliche, but at the end of the day, it's really, A, do they have good leadership skills? And B, are they coachable? And if they've got those two things, generally speaking, you can get somebody through that role. Um, so yeah, I mean, I think that's it. It's certainly a challenge. You're in the top seat for the first time, and all of a sudden everybody's looking for you. I used to joke about it when I became president of Legrand. I used to tell people, all of a sudden I'm a genius, and I didn't get any smarter. I just got a title, but now I'm a genius, right? And it's tough. You don't always have the right answers, and so you got to know when to shut up and listen.
Yeah. Yeah. Hi, Lisa.
Hi there. Nice to join you all.
Yeah.
I think those are great comments. And, I'd agree with Mark. In my experience, typically in mid-market, it is tricky, right? There's so much nuance the environments are completely different when someone's coming from larger structured environment to a much more owner mentality environment in PE. You treat the money like it's your own, and with great sensitivity toward multiple stakeholder agendas. So it is a very, very different mindset and way of operating. What I would say is that, as a recruiter, I'm always about the balance between someone's experience and where those common connections are that they bring into the role, and their fit, right? Which is the most important thing. Like, do they fit into the management team? Do they fit from a way of working and strategizing with the private equity firm? I mean, these are critical. This is, where it's going to go off the rails, if it's going to go off the rails. And, I can say, like, if I think back, especially to all of my more recent work, typically my clients in private equity want to see someone who's been in a private equity environment, because they understand. They've got some experience with all of the complexity of it, whether and dealing directly with the board, right? So taking someone out of a large structured organization that's never really dealt directly with the board or a very senior, the top level of the leadership team, it's a stretch. It's going to be a difficult leap for them. And then, of course, the other thing, which, Mark has pointed to a couple of times is, it's all about the situation, right? For alignment. That's where the leadership fit comes in. Is this a growth situation? Is it a turnaround situation? What has to happen first? I think we all understand that in private equity, operational savvy and chops is critical in many of these situations. Again, to Mark's point, because there's stuff that has to get done before you can do the big vision part, right? So these are all things. I could go on. I would have we talk all day about the long list of things that, as an executive recruiter, you have to be aware of and you have to be thinking through. And I think, if there is no private equity experience in the background, it could work. I'm not saying it can't, but the best, I think, situation is if someone has some structured organization in their background, some foundational experience where they get what's important, structure, process, all of these good things. And then maybe they've gone off into a smaller environment where all the stuff has hit them in the face and they've had to learn how to manage through a myriad of different complexities and problems solving and all that. Because then they have something, they come with an experience that's closer to going into a mid-market portfolio company, right? So the blend of those two things is kind of like the ideal situation. I have found and very attractive for most of the clients that I've worked for in private equity. So, yep. And, leadership skills have to be coachable, all that good stuff. I mean, I've run into so many times where um, someone who has the functional expertise has been elevated into a first-time CEO role, and they just cannot let go of,
Of the function.
working in the details of the function.
Yeah.
And that serves no one, in that situation, it goes from strategy to stalling at an operating plan
Yeah.
because they can't pull the trigger, right? They're just so caught up in details, and that doesn't work. So I'm going to stop talking. I hope that was helpful to the discussion,
That's great. Thank you. Yeah. I want to pivot something that Lisa said about the importance of fit. And Mark, you'd mentioned this, I think, in part from in addressing Simon's comments. This is not all about organic growth,
Right.
and a lot of it is going to be about doing bolt-on acquisitions, what have you, in this. And private equity groups are, in large part, that's their strength, is understanding the value of organizations and looking, doing the due diligence and finding companies to put in. But there's a really difficult part that falls on the CEO, not so much on the fund, and that is the integration of the acquisition and what's involved for that to succeed. And I bring that up because of what Lisa was saying about fit, and even thinking just about the culture that's involved there. And so I'm kind of curious your point about what do firms often underestimate about the post-acquisition culture work that has to go forward?
Yeah, no, I think if an acquisition's going bad or an integration's going bad, it's 9 times out of 10 it's culture, right? And its approach. And so, um, private equity firms are good at doing M&A, but unless they're big firms where they've got industry experts, they don't necessarily understand the industry that they're buying into. They know it, but they don't really understand it. Now, there are exceptions to that. Obviously, there are groups that focus on nothing but medical or what have you, and they know those pretty well. But at least, especially in the lower middle market, they typically don't know the industry very well. They can go in, they can do the financials, they can do all that, but at the end of the day, they don't spend a lot of time understanding the cultural differences, and that falls on the CEO and whoever is helping him do the integration or her do the integration. It falls on them to get that done. And one of the things I learned, one of the things at Legrand, and we did a lot of acquisitions at Legrand. One of the things I learned at Legrand that was different from my GE and Honeywell days is you don't go in and drop the playbook on the desk day one and say, okay, guess what? Rip off, company A tag and put your company B tag on. You're a GE guy now. Here's the playbook. Learn it, study it, go do it. Lots of times that doesn't work. It's a recipe for people, exiting, and you lose intellectual property, you lose customer relationships, all those kinds of things. And so I think spending time in due diligence, understanding the culture, understanding the cultural differences. Is it a growth-oriented culture? Are they self-starters? What what kinds of things do they do socially as an organization versus the organization you're in now? All those things become very important. And then you pick your battles, right? There are a lot of things that don't really need to be addressed from a culture standpoint. There can be elements of a culture that are different from organization to organization. The ones that are important are the ones that really are going to enable you to grow, to make sure you get what you need to get out of the organization from profitability. The rest of them, you let people be people, because if you go in and try to change everything, some inevitably one side or the other is going to feel slighted. And so you don't want that. You don't want it to be, oh, they're company A guys, they get what they want. We're the,
Right.
we're the piss ants, and you don't want to do that. And so it's very important to find that balance, change what needs to be changed and leave what doesn't need to be changed alone. Over time, you can do those kinds of things, even in private equity. We're not talking about 10, 20 years. We're talking about, 2, 3 years. Over time, some of those things can slowly morph, but don't do them if they're not necessary, because you're gonna without intending to, you're gonna slight people, and that's when you get voluntary turnover.
Yeah, and what I've seen, and it's not necessarily a dynamic that is specific to private equity, but it happens
Oh
in
yeah.
the integrations of almost any kind of acquisition. Now, in the work that we do, and our base of business was originally in senior onboarding, and we still do quite a bit of that. But that was really kind of the thing that started with Executive Springboard, um, and we recognized that maybe half of executives in senior roles fail within the first 18 months, just writ large.
Yep.
It's much higher in acquired businesses, in large part because they didn't have a whole lot of say in being there, right? In other situations, somebody was actively trying to get recruited. Somebody's been in an organization and got promoted, and so their feelings about the company they work for can be totally different than.
Look, I've seen deals even at the corporate level where the acquirer comes in as the conqueror,
Yeah.
and that is just the worst scenario you can have. I mean, look, you can go back, for those of you that might remember, when Allied Signal and Honeywell merged. That was a disaster. I was there. I was an employee of Honeywell for 6 months when that finally closed, and I came from GE, so I knew what to expect from Allied. Right? Allied was just another GE. Now, and I love GE. Don't get me wrong. In case anybody takes my comments as I don't love, I love my time there, but it is what it is, right? Or was, I should say, was what it was. And Allied came in there, 50% of them were ex-GE guys, and they came in like the conquerors, and you got this Honeywell Midwest Minneapolis mentality, and they just steamrolled them. It was not good. It was not good.
Yeah. Anybody else with a comment on this, and how the culture part plays out in integration? Yeah. Okay. One of the things that we talk about with Executive Springboard is, because it's one of those things. Again, if I stick with onboarding into a new role, but not even, it doesn't even have to be in that. Almost anybody who has an agenda for change. One of the things that we find is, people often feel like they're going to be heroes if they're able to beat the expectations on the cadence of change by a couple of weeks, only to find that by going with their head down and running as fast as they can, and then going around a corner and turning around, nobody has followed them, and they're in a lot of trouble. So, advice that we often give is slow down, almost to a point that can be uncomfortable, to make sure you have an alignment. I'm wondering if it's a different law of physics in private equity. Um,
No, no, it definitely isn't. And I think look, in with change, you got to bring, you got to make sure you don't get ahead of the supply line, right?
Yeah.
In any battle. And communication is super, super important. I see a lot of guys and gals that don't take the time to sit down with the employee base and say, look, we need to make a change, whatever that change is. We need to make a change in how we do this. And here's why. Here's what's going on today. Here's what the effect of that is. Here's what we want to change to, or at the very least, here we need to make a change. We're not sure what it is. We're going to work on it together, but here's the outcome we need to get. And most people, if you sit them down, you explain that to them, and sometimes you got to do it 3, 4, 5 times before it sinks in. But if you take that time, you're more likely to build, number one, some trust and confidence in what you're trying to do, and people will at least try to understand it. There's nothing, I tell people all the time, there's nothing worse than not communicating with your employees, because what you do is you create a vacuum, and people are going to fill that vacuum, and 90% of it's going to be things that aren't even true, but they're going to fill that vacuum, and that just spirals out of control. And all of a sudden, you've got rumors that are widely spread about what's going on because they don't have the facts. And so, I had this conversation even with my mentee is, look, communicate, over communicate, because people want to know what's going on. They have a natural curiosity to know what's going on, and they're going to come up with an answer, and you'd rather it be the one you give them than the one they make up, because the one they make up is always going to be worse.
Yeah.
People, nobody comes up with positive messages when there's a lack of information. It just doesn't happen. So.
Yeah, it's interesting, and because I would have come from a different point of view. I hear you on this, but I guess I was wondering, because of the time frame in private equity, thinking that there's an exit somewhere between, say, 3 and 5 years, that at least the leadership team is less resistant to change than maybe some others. But I think you're making a really good point. If that's how the leadership team is, the people who are getting things done are their people.
Yeah. Well, look, I think the leadership team, the reason I went right to the general employee population and not the leadership team is, that's part of due diligence, and companies shouldn't miss that in due diligence. You you know, any deal I've ever been involved in, we've laid out a 100-day plan and a 5-year valuation expectation ahead of time before we close.
Yeah.
Because if you can't get the leadership team bought into that in due diligence, you're never going to get them to buy into it after. And so, that's just another point of failure. So to me, you get that buy-in up front.
Okay.
I was in one situation where everybody nodded their heads and we closed. That was at Legrand, and then all of a sudden they were fighting us on every single thing we did. And some of the things they fought us on were things that they recommended we do, but couldn't pull the trigger themselves. And what happens in those situations is, in 12 months you've got a whole new leadership team. And in the world of private equity, you can't afford that.
Yeah. Yeah. I'm curious a little bit, advice. So somebody is new as a CEO in a private equity organization, in a portfolio company. They come in, they turn over the rocks, and they find some nasties there. I'm curious a little bit about how somebody can be effective in surfacing bad news without losing confidence among the people from the fund, so the board, et cetera. Any advice there?
Well, I would say, it's kind of like The Godfather, right? The Godfather appreciates bad news right away. So I would say, you didn't create the problem, you found it, and don't hide it. You report it, and ideally, you give some thought to how you solve the issue before you bring it forward, because generally people, I know I do, I would prefer if somebody came to me and said, look, we got a problem, here's the problem, and here's kind of a couple of different paths to solve it, and here's what I would suggest. But at the very least, come to me with the problem, we'll solve it together. But you presumably the person didn't create the issue, so you can't really hold them accountable for it, but it's got to be fixed, right? But early and often, don't sweep it under the rug or hope that it's going to go away, because it'll come back, right? Then it's your problem.
Yeah, exactly. And
Right.
you might get, there might be that one time level setting opportunity that you have, but you got to come with the data,
Yeah.
and come with what appear to be solutions or options anyway with that, right?
Right.
Yeah.
Yeah.
All right. Is there I think you may be the first person, and this may have been my own ignorance, but I'm curious a little bit about what an independent sponsor does.
Yeah, so I mean, this is kind of the independent sponsors has been around for a while, but it's becoming much more popular in the lower middle market now for a couple of reasons. It's harder and harder for private equity firms to find proprietary deals, deals that aren't on the market, that have a broker and there's a book out and it goes out to 400 of your friends and family, for people to bid on. And so private equity firms are starting to look more and more to people like me who come from business, know how to run companies, probably have some expertise in a certain market area, because with that expertise comes relationships, and the companies and the players out there, and you can find proprietary deals for them, as well. And you also have the market knowledge, so that when they get into the deal, um, you can steer the ship in the right ways. And so that's becoming more and more popular. So what they do is they find people like me who they say, look, we want to do a deal with you. Go out and find us a company, and we'll back you. And then what ends up happening is I become, in this case, myself and my partner become the sponsor of the deal. So it's a little bit different than just being on a board. You're more financially invested,
Right.
right? You get a finder's fee up front. You get that generally you get roll that into equity. You get a management fee for really operating the company along with the owner, with the leadership. And then you get at the end, what they call a carry or a promote, which is based on, it's a scaling up percentage based on how well the company does, on invested capital. And you really you're the group between your financial backers, whoever they are, and and the leadership of the organization. And some of those independent sponsors are, I've actually done some work for independent sponsors that were very hands off. Uh, Myself and Joe are much more hands on. Joe is an operating partner for New Spring Capital. And I've always operated businesses, so I do this because it's fun and I like getting my hands dirty. So we get a lot more involved. Not to the point of telling the owners, you'll never hear me say, tell a CEO what to do, but I will make strong suggestions on what I think they should do. And so that's kind of what we do. And then I'm, because I know a fair amount of people in this particular industry, I'm able to find, a lot of opportunities for add-on acquisitions that aren't public,
Yeah.
right? And
Yeah.
so it's like I said, it is becoming more popular. If you look at some of the firms out there now, they're starting funds that are dedicated to independent sponsors. Instead of having a fund that's a mezzanine fund or a franchise fund or a medical fund, you'll see independent sponsors. Is a good example. That is one of my financial backers is Align Capital, and they have a fund called Align Collaborate, and that's all they do is back independent
Interesting.
sponsors. So.
Well, we've got like 5 minutes left. I'd love to open this up to the folks who are on the call if you have any questions of Mark.
We were crystal clear,
Are we
Steve.
being
Hi,
shy?
Mark. Let's just address the board specifically, because
Yeah,
that composition and the dynamics of that vary tremendously
yeah.
as you go up the scale, right? What's been your biggest learning about composition interactions with the board?
I think I've come onto boards later in the cycle in some cases where there hasn't been anybody with any industry expertise. It's made up of, somebody from the bank, three or four guys from the private equity firm, um, and the owner sometimes. And I think, I'd like to see boards that are more diverse. And I don't mean that necessarily. I'm great to, gender and culture, but more diverse in experience. Even if they don't have experience in the particular industry that they're sitting on the board of, I think people, especially operators, have been and done that, right? They've been and done things in different businesses. They've seen things that work, things that haven't worked. And I think having, a little bit more diversity of experiences on the board is a better situation. Um, Typically, boards tend to focus on the financial piece and one or two people that know that particular industry, and so they know what they know. And so I think diversity would be when I see a board that's a little more diverse from that perspective, I like it.
Maybe if I can ride on top of that question a little bit more,
Yeah,
if anybody else is itching to get in, please, I'll defer. So when you think about, we've talked a couple of things about culture and sort of extricating from the founder and other things today. So, lower middle market, family firms, etc.
yeah.
When you think of being the CEO of one of those companies, to what extent have you seen the board engage in things like culture and some of these more esoteric topics that aren't, just purely financial or strategic?
I think again, it depends on the makeup of the board, right? That's why I talked about experience. You know, a board that's just all PE guys, most of those guys, I mean, they're all great guys, but 90% of them not run businesses, right? So they don't know what it's like to be on the front end of an integration. They don't know what it's like to lead, you know, 50 to 2,500 employees. They've not done that, right? Now, again, like everything else, there are exceptions to that, but generally speaking, they don't know how to do that. So having people on the board, if there are people on the board that have that experience, they can be of great benefit, in my opinion, to the CEO. Um, and that's why my first answer to your question was diversity of experience.
Thanks.
Anybody,
Interesting.
anybody else for a last question?
I will go. So my name is Rhiannon, and I am in a function of HR that is not talent or staffing. But I'm just curious. I joined this call because I've been acquired, or we were the acquiree. That's a lot more, well, acquiring is a lot more fun than being acquired. But um, several times, probably 8 or 9 in my career. And I'm just curious how HR leadership, besides staffing, recruitment, and doing the hiring piece, what we can do to facilitate ease or a better transition.
Yeah, that's a great question, man. This gets back to culture. You know, in my opinion, no one has a better understanding of the culture in an organization than the HR team. And they're kind of, if it's a good HR team, they're a very trusted source for the employee base. And so if they're hearing it, and sometimes more so than the CEO, right? Because sometimes employees will have a more jaded view of where the CEO's alliances lie, right? And what drives them. Whereas the HR person presumably is there for their benefit. And so you're a more trusted source. And so, the one of the I won't say it's always the first thing I did when I do acquisitions, but one of the first things that I did, especially when we were buying bigger companies, was meet with the HR team and make sure that we talked about what the goals and objectives are for the acquisition, what the goals and objectives were going to look like for the company, and what kinds of changes that's going to require. And then getting a good assessment, particularly of the key leadership, right? Who are the people in the organization that can get us there? Who are the people that you don't think can get us there? I used to, when I did acquisitions at Legrand, my VP of HR would come in with me. We would do interviews with all the leaders,
Yeah.
one on one, 2-on-1, she and I, and whoever that particular leader was. And we would put all that together. We do, and we still do. My partner's a big proponent of this as well. I love any of these predictive indexes, right? Especially when you're trying to bring cultures together and doing predictive understanding, the key drivers of the leaders so that you're making sure you've got good matches. I think those are very, very important as
What
well.
motivates each person? Yeah.
Exactly. There's no better way to engage employees than understand what's motivating them and how to work together.
Is it fair to say, though, for the most part, and it's okay, I'm a big girl, I can take it, that most teams don't give it a lot of credence or
When you
time?
say teams, you mean the employee base or the acquiring
Like
company?
private equity teams.
Here again, I think it depends. I wouldn't make that blanket statement. I think it depends on the makeup, right? There are, good private equity firms view that as a key to growth,
Yeah.
Fortunately, all the ones that I've worked with, I'm going to think about this before I make a blanket statement, but let me just say most of the ones that I've worked with do care about that. Predictive indexes and things like that are a natural progression for them. And some of them even have an HR person, on staff as well,
Okay.
the bigger ones.
Yeah.
So I think I think it really, the answer is I can't tell you that it's 50%, 60%, or 10%, but the good ones do care about that. And in my world today, most of the companies that I get involved in the lower middle market typically don't have an HR person today. Like the deal I'm involved in right now, I hired one of my old HR leaders from Legrand, who's retired, to come in and act on a consultant basis to put a lot of the processes and things in place that we're going to need. Because again, thinking ahead, do they have it today? No, they didn't need it for the last 3 years. They're going to need it for the next 3.
Totally.
And so starting out of the gate, we're doing that now. So
If I can add
Thank you.
something, I've heard Mark say this. I've heard Mark's mentee report on what Mark says, which is for the CEO, they have to have 2 really good friends in the organization. One is the head of HR and the other is the CFO.
yeah,
Those are
absolutely.
2 people that they count on. And I would say beyond what we're just talking about here, Rhiannon, it's also the systems to put in place for HR to get
Yeah.
you to set up the foundation for the scaling that has to happen.
Right.
Yeah, I mean, you'll ask a CEO of a company, well, how do you do merit increases and bonuses? Well, I don't know. I just do them. So we do, salary increases or cost of living increases, and I decide on bonuses as to, who contribute. It's such a unintentionally biased approach, and then try to do succession planning in that environment is impossible. So you've got to have that. This is an area in particular where putting a process in place out of the gate, in my view, is critical, because you don't have good people, you're not going to get a good outcome. So.
Awesome. I have to hop to another meeting, but this was great. Thank you.
Thank you. And I want to be conscious of everybody's time. We've run over. It's been great being with everybody today, and I will send out a link to this video for anybody who wants to review it at their own leisure afterwards. Mark, thanks so much for joining us and sharing your insights with us.
Right. Great, guys. Thank you so much for listening. I appreciate it.
Thank you, everybody.
All right. Bye-bye.